What is the market? A financial market is used to describe any marketplace, where buyers and sellers join in with the trade of assets such as equities, bonds, currencies and futures. Markets are typically defined by having transparent pricing, basic regulations on trading, costs and fees, and market forces making the prices of securities being traded. Markets can be found in nearly every corner in the world. Some are very small, with only a few participants, while others would trade trillions of dollars daily. We, as traders or investors, have access to a huge number of financial markets and exchanges, with different financial products. Some of these markets have always been open to private investors, others remained exclusive to major international banks and financial professionals until the end of the 20th century. So, what is the reality behind market quotes, prices and charts? When we check prices online, follow ticks on our screen, what exactly are we looking at? What is this market that we want to analyze and trade? Amateurs act as if the market is a place for trading. Professional traders know well that the market is a giant mass of people. Every trader wants to take money from others by outguessing them on the next direction of the market. The participants of the market crowd live at different corners, but are brought together by modern technologies in the pursuit of profit, at each other's expense. The stock market is a financial market that allows us to buy and sell shares of publicly traded companies. The primary market is where new issues of stock are first offered, such as IPO. The subsequent trading of securities that we usually get in touch with is the secondary market. Over-the-counter market, or OTC, handles the trading without going through the exchange. For securities, those trading on the OTC market are usually smaller companies, as it requires less regulation and less expensive to be traded on. A bond market is where the debt, credit, or fixed income securities are traded. A bond is a security in which investors loan money for a fixed period of time at a predetermined rate of interest. A money market is a financial market that trades securities with very short maturities, typically less than a year, such as certificates of deposit, bankers' acceptances, bills, notes and commercial paper. The derivatives market is a market that trades securities that derive its value from its underlying asset, such as forward contracts, futures, options, swaps and CFDs. In a nutshell, the market is a crowd of people, each tries to take money from others by outsmarting them. The market is a very harsh environment because everyone is against us, and we are against everyone. Not only is that market harsh, it's a minus-sum game, because we have to pay whenever we enter and exit. We have to break even from spreads or commissions and slippage before we can make a profit. The moment we place an order, we have to pay a commission. Although commissions have become much smaller in the past decade. Without proper care, even seemingly small numbers can raise a huge barrier to success. Slippage is the difference between the price at which we place our order, and the price at which it gets filled. It's like paying $5 for a coffee, even though the posted price is $4.90. A dime is nothing, but if we are buying 1,000 with a dime slippage, it will become $100 per order. Winners always receive less than what losers lose, because the industry feeds money from the market. That's the nature of the market that we will be dealing with.